The current value of my long-term dividend growth stock portfolio is over $207,000 with $127,000 invested. This puts my total return at $79,000 or 62%. I've built this account primarily over the past 5 years, and I'm still deeply positive despite the 2025 sell-off. This week, the S&P 500 is down over 4%, and the NASDAQ 100 is down over 7%. Investors are starting to be worried about a broader market crash, with the Fear and Greed Index now showing extreme fear. This is actually the lowest level of the past year. Personally, I view this sell-off as a buying opportunity. Today, I'm going to share 3 stocks to buy in this 2025 market sell-off. They are all incredibly high-quality businesses down from their all-time highs, with strong financial positions and clear paths to continued earnings growth. With each, I'll provide my updated investment thesis and a bull-bear case. I've already bought 2 of these stocks during the week, and I just put in orders for the 3rd. On top of that, I'll share an updated look at my entire portfolio and the dividend income that it generates. With that said, let's roll the intro. My name is Zach. Welcome to Dividend Data. Every month I analyze the progress of my long-term dividend growth stock portfolio to stay accountable and hopefully motivate others as well. If you enjoy the video and want to see future updates, please hit the like button and subscribe. If you'd like to track your portfolio and dividend income just like me, check out dividenddata.com. We just launched automatic tracking with Fidelity, one of our most requested features. And by the way, we support hundreds of other brokerages as well. Right now, we are running a special March sale where you can get 50% off the annual membership. It locks in that lower price for life. To make sure you get access to this exclusive deal, use the link in the description and pinned comment of the video. Or in our normal checkout, add the promo code MARCH to get 50% off the annual plan of dividenddata.com. That's the promo code MARCH. On top of portfolio tracking, you get our full stock analysis tool and our new AI analyst where you can ask any investing question. I'll be using both throughout the video. And of course, I want to thank everyone for your support. The platform will only continue to get better and better. Now let's dive into the stocks. Everyone is in a different phase of life. I'm currently 25, going on 26, and I have a long investing time horizon. It's for that reason I want to invest in companies with enduring competitive advantages that can continue growing their dividend payments year after year. In order to accomplish this, a company must have a sound business model that continues to grow their earnings and free cash flow over time. They also must have opportunities to continue growing that free cash flow. I prioritize companies that reward shareholders with both growing dividends and share repurchases when possible. I tend to focus on dividend growers and initiators, as historically they are some of the most reliable stocks where you can get a high total return and growing income. And before I analyze my top 3 stocks to buy right now in this 2025 sell-off, let's go over my current portfolio and its dividend income. I currently have 12 stocks in this portfolio, with it heavily weighted towards my top holdings. For example, I have 26.8% of my portfolio in Visa and 20.1% of my account in Microsoft. I consider them to be 2 of the best dividend growth stocks. But I also have some high-yielding stocks in my portfolio, such as the Altria Group, ticker symbol MO, and ExxonMobil, ticker symbol XOM. However, I have held those stocks for a while and nabbed them at great prices, so my dividend yield on cost is fantastic there. These are 3 stocks I have held for quite a while, and my total return is pretty high on all of them. However, I do have 2 newer additions to my portfolio that I added this year. That's Alphabet, ticker symbol GOOGL, and Salesforce, ticker symbol CRM. I don't want to spoil anything, but those might be 2 stocks that I talk about later in the video. This account is currently projected to generate $4,659 in annual dividend income. That's $1,100 every quarter, $388 every month, $12 every day, and 53 cents every hour. And this is all passive income that I reinvest to acquire more stock. And I plan on just building this up over time. And eventually, hey, I could have this income that could potentially supplement my lifestyle, or one day even retire off of. You'll notice that the distributions are very lumpy depending on the month. I'm not really worried about this right now, as I'm young and not planning to live off of my dividends anytime soon. And even then, I wouldn't really worry about that unless you had trouble budgeting. So here you can see the dividend insights for my overall portfolio and the stocks in my account. My dividend yield on cost overall is 3.15%, and from reinvesting dividends, that's gone up 0.51% to 3.65%. As you can see with my big dividend payers like the Altria Group and ExxonMobil, I have a lot of these DRIP shares, which are shares from dividend reinvestment. With Altria, that's 95 shares. For context, that's another $5,200 of total value. But it's actually more powerful than that because it gives me another $387 of dividend income that I can use to reinvest and buy more shares in the future. And this is the compounding effect of dividends that dividend investors just love. With both Altria and ExxonMobil, you can see that reinvesting these dividends has boosted my initial yield on cost significantly. I've got some pretty big payments coming up for me with Visa, ExxonMobil, and Microsoft. That will be $92, $166, and $88. And here you can see my personal dividend history. I've been tracking this for a long time, and you can see how my dividend income has now grown to all-time highs. And this is while my strategy has shifted. Originally, I followed a much more high yield approach, but I have since gone to a lower yield approach where I'm focused more on total return. And even since then, I'm still growing my dividend income and hitting all-time highs. Last year, I earned $4,474 of dividends. And so far in 2025, I have $712. January had my highest month ever at $626. February was a very low month as I only had Apple and EPD. And while this dividend income doesn't seem like much right now, the long-term compounding effect of this is massive. The real impact of dividends is only revealed on a long time scale. For example, from 1960 to 2023, you can see here the difference between reinvesting dividends and not reinvesting dividends in the S&P 500. It's massive and only grows with time. And the reason is you're getting this entire other compounding effect of reinvesting and increasing your future income. It's a level of external compounding on top of all these businesses you're investing in, which are growing as well. So what stocks have I added to lately in my portfolio? Well, as I mentioned, I was using this recent sell-off as a buying opportunity for some really high quality companies I'm looking to build positions in. And here are the stocks that I bought since my last update, and much of that was just this week. I bought 7 shares of Google at a cost per share of $179.70, and I have bought 3 shares of Microsoft at a cost per share of $407. That comes in at a total of $2,478. Now, what's interesting is that both of these stocks have sold off even more. So yes, I have additional orders in for these stocks, and I'll continue to dollar cost average down as they sell off. All right, so let's get to the top 3 stocks that I'm buying right now. That's Microsoft, Alphabet, and Salesforce. Yes, I did not buy Salesforce yet, but I just put in an order for it because it sold off massively the other day. All of these companies are actually down a good amount. Alphabet's down 11.98% from its 50-day average and 4.15% from its 200-day average. Salesforce is down 11% from its 50-day average, and Microsoft's down 7.5% from its 50-day average and 7.8% from its 200-day price average. So as I mentioned, I'm using this as an opportunity to build up my holdings in some high-quality companies that are selling off. But why am I picking these 3? Let's break down each. I'll give a brief stock analysis and then give my bull and bear case. We'll start with Alphabet, ticker symbol GOOGL. It is also ticker symbol GOOG, depending on which version you buy. It is down 9% over the past 5 days and 17.4% over the past month. However, when we look at the long-term picture, things have been pretty good for Alphabet. As you can see, earnings per share are currently at all-time highs, and this big tech giant is one of the highest quality companies in the world. And you'll see that if we just do a brief run through some of their key financials. Revenue per share has grown at a 19.14% 10-year compound annual growth rate. This is a very high margin business too, with 58% gross margins and 28% net margins, and that's even better in their core search business. Free cash flow per share is growing at a 21.3% 10-year CAGR, and they just had an all-time high in quarterly free cash flow per share. This company has a stellar balance sheet with $325 billion in shareholder equity. They have $95 billion in cash on hand, so they can fund pretty much any project they want, and they have started redistributing some of that cash to shareholders. In fact, they just initiated their first dividend payment, which is very sustainable at below a 10% payout ratio. So we'll see how that grows in the future. They definitely have high capacity to grow that dividend over time. And as we go back to their balance sheet, you can see they're in a great position. They have negative $70 billion of net debt, and this company generates crazy free cash flow. So Alphabet is a money printing machine and a very high quality company, and typically these big tech giants trade at a pretty high valuation. However, Alphabet is trading at just 20 times earnings per share over the trailing 12 months. And 20 times does not really line up with these high growth rates. If we just take a look at what analysts are projecting for Alphabet stock, you can see that they're projecting double-digit earnings per share growth every single year. And by fiscal 2029, that would be $16.28 of estimated earnings per share. So based on today's stock price, that would be a 10p ratio. And for a dominant high-quality company like this, that seems a little ridiculous. And if you assume that they trade at a 20 or 25 multiple in 2029, there's going to be massive gains from here. And even at today's price, the company is trading below their lowest price target on Wall Street. There's about 20% upside from here based on the consensus price target. And the company has financially been performing pretty well lately. In the latest quarter, revenue was up 11.8% year over year, operating income was up 38.3% year over year, and earnings per share was up 31% year over year. If you're investing in Google and want to understand their two core business segments, you have Google Services, which is the dominant part of their business that includes mainly Google Search. That's the cash cow for the company. They had $84 billion of revenue and grew 10% year over year. And this is the bulk of their profitability. And the main parts of this business are Google Search and YouTube ads. Those are the key growth drivers. So in terms of Google's profit, you mainly can think of it just as a digital advertising company in search and then in YouTube display ads. And if we take a deeper look at their Q4, you can see that search is still by far the most dominant part of their business. And despite what you hear about it declining and all this competition, they are still growing massively year over year. YouTube ads, while it's growing fast, is still a much smaller part of the company. But the platform dominance of YouTube is as strong as ever and will continue to grow in the future. The other core business at Alphabet is Google Cloud. In Q4, that had $12 billion of revenue, which grew 30% year over year. So this is a much faster growth business. However, the margins are not as good as something like Google Search. It's also where a lot of the capital investment I will soon talk about is coming. Google Cloud will increasingly become a bigger part of their business, but in terms of profitability, it is small potatoes right now. The operating income for Q4 of Google Cloud was $2 billion, which was more than a double year over year. But we're still comparing this to Google's broader business with $32 billion of profit. So if you're analyzing this company, in reality, your entire analysis needs to be around Google Search and how you think that will do in the future. And as I explain this bear bull case right now, that'll be a core part of it. For Google's future outlook in the upcoming quarters and years, what you need to understand is they're investing heavily in AI. This means a massive ramp up in capital expenditures. They will invest approximately $75 billion in capital expenditures in 2025. That is up from $52 billion in 2024, which is up a lot from 2023, where it was only $32.2 billion. Now, what's amazing is they might continue to grow free cash flow because the actual business and their cash from operations is growing even more. But the big question is what kind of return they get on this investment. And that's where we get to the bull and bear case for Alphabet. And by the way, I thought this would be fun. I asked the AI analyst at dividenddata.com to create a bull and bear case. Don't worry, I'll be putting my own opinion in it too, but I thought it'd be interesting to see what it thinks, and it looks like it did a pretty good job. So obviously the entire story around Alphabet, both in the bull and kind of the bear as well, is artificial intelligence, AI, and the advancements that could help the company, in which they're a leader in the category, but then also risk around potential return on investment in their CapEx and in the competitive landscape. Most notably, the dominance of search and whether or not things like ChatGPT incrementally start to take search market share away from Google, which is the main cash cow of the company. Now, in my opinion, I think that risk is overstated, but that point might need a full video in itself. So I'll probably do another Alphabet stock review video where I go in depth around that business. But then there's also the bull case with AI. We have it directly translating to revenue in Google Cloud, but the company has also been using machine learning and AI advancements internally for years, and that only continues to get better and better. So the interesting thing is while you see competitive risk on search, search itself is becoming way more profitable as machine learning algorithms become more effective in matching ads to different searches and tracking user behavior. And this is actually one of the core applications of a lot of machine learning and artificial intelligence right now. You see this also in the ad business for Meta platforms, being both Facebook and Instagram. Digital advertising is one of the best things to be enhanced by AI. So I think it's quite possible that their core search business actually becomes more profitable from the AI advancements. And by the way, that will also be true with YouTube advertising. And let's not forget this company has some of the best technical talent in the entire world and is a leader in AI. So there are these possible bull cases that possibly we're not even thinking of right now. And then the other main risk with Alphabet that's completely outside of the whole AI thing is just the advertising market in general. And a lot of that's downstream of the economy. So if people stop spending money on ads, you'll see a dip in their advertising revenue. And this is a big part of what caused the 2022 sell-off in Alphabet stock. We had a weak advertising market at that time. So that's an interesting kind of cyclical part of their business model. Over the long term, since I'm planning to stay invested in this company for a while, I'll likely use those dips as big buying opportunities. If you can't tell, I think Alphabet's a fantastic investment right now. But again, you should do your own research before making any investing decisions. And there's a lot changing in the market, especially around AI. By the way, if you want to use the tool I'm showing throughout the video, it's available at dividenddata.com. And right now you can get 50% off our annual plan. You can lock in that discount for life. And this is just a fantastic deal. And you can get access to the portfolio tracker, the AI analyst, and the stock analysis tool. Click link in the description and pinned comment of the video, or enter the promo code MARCH at checkout. For stock number 2, I'm going to pick Microsoft, ticker symbol MSFT. This is one of the top positions in my dividend growth stock portfolio. Again, we're going back to the big tech companies, and the reason why is that these are kind of the best companies on earth. As you can see, they just have pure financial dominance and great locked-in business models. Microsoft stock's down 5.91% in the past week, and is actually down 3.73% over the past year. And I've barely bought this company in the past 2 years since I built up my initial position in fall 2022. But now I'm starting to feel comfortable to nibble again because the company has continued their trend of earnings growth. And I think they're on a great track for long-term continued growth. Microsoft's revenue per share is growing at a 12% 10-year compound annual growth rate. Net income per share is growing at a 16% 10-year CAGR. Free cash flow per share is growing at 11.95% 10-year CAGR. This is a very high margin business, 69% gross margins, 35% net margins. They have $302 billion in shareholder equity, so they're in a fantastic financial position. $71.5 billion of cash and short-term investments. Negative $9 billion of net debt. And this company is a reliable free cash flow machine. Also, when we compare this to something like Google, they actually have much more reliable revenue and profit since so much of their business is on a recurring and subscription plan. Where if we go back to that Google analysis I just did, there's a lot of risk in the advertising market, which can fluctuate over time. Microsoft's business is far more predictable, and that's part of the reason why they trade at a higher valuation. Currently 31 times trailing 12 months earnings per share. Microsoft has a long history as a dividend growth stock. They've been growing their dividend every single year since 2005, and it's increased by 10% every single time. The 10-year compound annual growth rate is 10.35%. This dividend is very sustainable with a 29% free cash flow payout ratio and 24% net income payout ratio. Overall, I view Microsoft as a very high-quality dividend growth stock, and they're projected for high earnings growth in the future. Similar to Alphabet, that's double-digit EPS growth. And by fiscal 2029, if they hit these targets, it'll be $23.30 of earnings per share. That would give them a 16.85 P ratio, but realistically, they'll still be growing and have future growth ahead. So they won't be trading at that price, probably again at a 30 P ratio. So the stock price will likely go up a lot from here. The consensus price target's $495.78, which implies 26% upside. And they're currently trading well below the lowest price target on Wall Street. If we look at Microsoft's latest quarter, they've been performing very good. Revenue's up 12% year over year, operating income up 17% year over year, EPS up 10% year over year. But the main growth business for them is cloud, and more specifically Microsoft Azure. Microsoft Azure grew 31% year over year. And if we look at their AI business, they just revealed this in the latest quarter, which is fantastic news. Their AI business in cloud is now at $13 billion of revenue, growing 175% year over year. So this will increasingly become a larger and larger part of their cloud business. By the way, this is their revenue run rate, so it's a projection of annual revenue going forward. And if we look at Microsoft's business more broadly, you have productivity and business processes, which is their subscription software, Microsoft 365 that they sell to businesses. That's actually still their largest business segment at $29.4 billion, up 14% year over year. And this is reliable, recurring subscription revenue, and they're adding AI throughout their entire Microsoft Office suite. Then you have their cloud business at $25.5 billion of revenue, up 19% year over year. Over the long term, this will likely become their largest business segment, at least in terms of revenue. So if you're analyzing Microsoft as an investment, you really need to just make up your mind about those two business segments. because then you have this more personal computing segment, which doesn't really grow that much. That's where they have Windows, all their PC devices like Surface. They have Xbox, which has become more interesting now that they had the Activision Blizzard acquisition. But gaming's a pretty difficult market in general. And then you have their search business in Bing, which is still very small, especially when you compare it to something like Google. And they had pretty good outlook. For the next quarter, they're expecting 19 to 20% revenue growth. And Azure's expected to grow between 31 and 32%, which is crazy for a business that big. They're also planning to invest a lot in AI infrastructure. This is similar to Google. Microsoft's already been a leader in this. And if we look at how their capital expenditures have grown, they went from $28 billion in 2023 to $24.48 billion in fiscal 2024. And Microsoft is already 2 quarters into their fiscal 2025. And their latest quarter was $15.8 billion. That puts them on a run rate of around $63 billion. And the Microsoft CEO, Satya Nadella, said this will be going up to $80 billion for this year. So again, if we get to a bull and bear case for Microsoft, a good amount of the risk just comes from questions around return on investment on this spend. But again, I think it's actually pretty likely they'll get a very high return on investment. And you can see that just from their revenue growth so far. And just strategically for these big tech companies, it's so important. They are leaders in this next technology wave. And a lot of their bear case is just whether or not they continue to adapt with all these changes around AI, which, would be making sure that Microsoft 365 is still a great value for their customers, even with a changing competitive landscape, and making sure that their cloud is one of the best places to go to use AI services. But again, I might do a full Microsoft stock review video in the future because I think that they have this killer flywheel within the business, especially with this technological wave around artificial intelligence. Microsoft's entire company exists around making businesses more productive and making developers more efficient and providing them tools and resources. They are a productivity software and infrastructure company. And I'll tell you what I'm pretty sure about in the future. There's going to be a lot more software, a lot more data, and a lot more compute needed. Also, the capabilities of these softwares and the value they provide to their end users is just going to increase and increase over time. So in my opinion, I think Microsoft is in a great strategic position in terms of market. That market is going to be a multi-decade growth opportunity. The question is, I guess, whether or not they can execute. Microsoft's one of the top stocks in my dividend growth portfolio. But again, you should do your own research before making any investing decisions. And then for stock number 3, I have Salesforce, ticker symbol CRM. This is another high-quality big tech company. However, a little bit different. This is an enterprise SaaS company. So they have very reliable subscription revenue. And you can see just how crazy this company's been growing. It's nuts. Over the past 5 days, Salesforce stock is down 7.5%. And over the past month, they're down 13.7%. They've basically been flat for the past year. And you might look at this and be like, oh my God, based on GAAP EPS, their trailing 12 months P ratio is 46.3. But again, this is a SaaS company with fast growing earnings. And in the latest quarter, they had $2.78 per share of EPS. So if we annualize that as in a forward-looking run rate, that's $11.12 of earnings per share, which brings us much closer down to earth with a 26.5 P ratio. And this company is projected to grow earnings per share in the double digits in the coming years. So the valuation, in my opinion, is very reasonable right now. And if we look at the historic financials of Salesforce, it's one of the most impressive charts you'll see. 10-year CAGR of revenue per share is 16.42%. And you can see this growth is so consistent and reliable. And again, we're talking about very high margin software businesses here. So 77% gross margins, 16.3% net margins. Free cash flow per share is growing at a 26.7% 10-year compound annual growth rate. It grew 32% this last fiscal year. Salesforce is a free cash flow machine. They make so much free cash flow. They have a strong balance sheet, $60 billion shareholder equity. They've got good cash, $14 billion in cash and short-term investments. The company has negative $11 billion of net debt. And because this company has such high free cash flow, they finally started paying a dividend. This is a quarterly dividend payment that's very sustainable with high capacity to grow in the future. And this company was in growth mode for a while, but they even started repurchasing shares. So Salesforce stock is currently trading well below the consensus price target of $345. That implies 16.9% upside. They are even currently trading below the lowest price target on Wall Street. And compared to Alphabet and Microsoft, the number one thing I like about Salesforce stock is that they do not have the capital expenditure problem, and they are just benefiting from everyone else's AI spend. They're not really doing it themselves. They benefit from the AI ecosystem, and they can implement that in their software. They're not doing the upfront investment. As you can see, their CapEx has stayed still at around $650 million. So this company's free cash flow is just going to continue to explode, which means more cash to potentially distribute to shareholders. In the latest quarter, revenue is up 8% year over year. Operating cash flow is up 17% year over year. They gave outlook of 7 to 8% revenue growth for 2026, and they're expecting their margin to grow. And again, I don't mean to be repetitive here, but in the bull and bear case, the main story here is AI in both scenarios. One, you have Salesforce using AI to enhance their platform, most notably with Agentforce. And the goal of this is basically to create a digital labor system. Right now, the core use case is around customer support, and they have over 3,000 paying customers in their first 90 days. These are like large enterprises too. And what I think is one of the most underrated things about Salesforce as an investment is they actually have a pretty wide economic moat in that they have this gigantic software platform with all of these different services, and they're really deep and integrated with one another. So once you get into these systems, companies, especially big businesses, they do not want to switch. And these things only get better and better over time. They add new features, and now they're integrating AI and the potential of AI agents, connecting that to all of this data that these companies are already using. So I personally am in the camp where I think AI is going to be actually a big bull case for Salesforce. However, there's also the camp that thinks it's a bear case, and that could be around things like execution risk in Salesforce not being able to implement and stay at the cutting edge, which could lead people to go to competition. But a lot of people are jumping way farther than that. They are arguing that the advancements in writing software with AI will actually lead to massive disruption, where they will see this onslaught of competition from people creating very low-cost versions of different Salesforce products, and even companies internally creating the tools themselves. Now, I do think that this is somewhat an inevitable thing that will happen, but when we weigh the risk here, it's also not factoring in at all Salesforce using those advancements, but it's also not factoring in at all Salesforce using those same exact advancements to continue to build on their advantages and make their products even better and deliver even more value to their customers. Also, I think a lot of tech people are in somewhat of a bubble where they do not realize how a lot of these large companies that are customers of Salesforce are not going to build this stuff themselves. And nor should they. A lot of the time, it's better just to focus on what your core competency is. So those are my thoughts on Salesforce. I recently added the stock to my Dividend Growth Stock portfolio, and I just put in new buy orders for the company after the recent sell-off. Again, do your own research before making any investing decisions. So those are my top 3 stocks to buy right now. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. And if you want to use my full suite of tools at dividenddata.com and even get live access to my personal portfolio, then please take advantage of our March Madness sale where you can get 50% off the annual plan of dividenddata.com. That is 50% off for life. Just click the link in the description and pin comment of the video, or enter the promo code MARCH at checkout. With that said, thanks for watching, and I'll see you in the next one.